Withdrawal Rate, the new 4%, episode 49 of TMR Retirement. We're going to find out. All right, Brian, we're here. It's
Yes, we
Friday.
are.
Tax season's over. It's the 17th of April. The market's at all-time highs again.
All glory.
And to kind of piggyback on our last video, episode 48, on episode 49, wanted to talk a little bit more about withdrawal rates because it's just I've seen a lot more charts and things out there, and I think it's a good time to revisit some of these kind of cornerstones of financial planning. And the 4% withdrawal rate, for those of you in the audience who don't know, that's kind of like the gold standard withdrawal rate that financial planners use. And we talk about withdrawing 4% of your liquid assets each year to supplement your income in retirement. And that is held up over the test of time. On pretty much any kind of back test you want to look at, it tends to play very well. And there has been increasingly new thought around, hey, maybe 5%, 6%, heck, maybe even 8% is the new 4%. Well, we have some actual data to look at and just kind of drive a conversation on what maybe makes the most sense. How much can you actually withdraw in retirement?
Yeah, it's a valid question. And, here we are. We're at the end of, tax day week here, and markets are at an all-time high. It's like as if this week was one of the fastest recoveries we've seen. Hormuz, for all intents and purposes, seems to be open.
Open for business now.
Yes, exactly.
Supposedly.
It's in markets move up, markets move down, as an investor and saver or if you're a retiree and you're deriving some income from that, from your investments, you see all this fluctuation and you wonder, hey, how much should I be taking out? So yeah, Dustin, I'm looking forward to this. This is a good conversation.
Well, and we talked last episode about the sequence of withdrawals and war gaming your retirement plan.
Yeah.
And this is kind of piggybacking on that, just because when markets do decline, your withdrawal rate really has an effect on your long-term success of not running out of money. And so that's why the 4% rule has always been something that really, like I said, it stands the test of time, where you wouldn't run out of money in ups and down markets if you just took out 4%. We've had really a decade, really since the financial crisis in 08, 09, that we've had probably higher than average equity returns. So it's probably been okay if you bump that up a little bit. But let's look at some actual numbers, Brian, on what type of withdrawal rates actually can sustain over multi-decade periods.
Let's do that. So we're chart on here.
All right. So what we're looking at is a couple different scenarios, and to paint the scene, really, the purple line is going to be a $1 million portfolio. And just to keep things simple, it's a very balanced portfolio. It's 50% stock, 50% bonds. Let's just say if you're a do-it-yourselfer and you just kind of said, hey, I want S&P and the ag and put them together, that's what you're looking at. For illustrative purposes, that'll work just fine. The purple is, again, the 4% rule. It's your money being invested since 2006, and you're taking out 4% each year. And the orange line is going to be these different withdrawal rates. And we talked about, well, maybe we'll start with the 8%, Brian, because that's kind of fun to talk about.
Oh yeah, that's a hot topic right now. It's like 4%'s yesteryear. I should be able to pull 8% annually.
I mean, everybody in this industry has clients who probably take a little bit more out of their portfolios than we would like. And when we have these conversations around what is really a safe withdrawal rate, this is why we lean towards the 4 to 5% rule. If you're at 8, so all the way over here on the right, that orange line is if you withdraw 8% per year. And again, I won't go back into the sequence of withdrawal table, but that's really what's happening here and why 8% is too much withdrawal rate in this scenario. You actually ran out of money. You spent $1 million, plus any growth, in less than 16 years. You ran out of money. Now, any financial planner, that's not going to be a comfortable place to be in. We're not going to advise our clients to take that much out and run the risk of depleting their portfolio within 15 years. I mean, we're planning for 30 years of retirement most of the time, maybe even longer, depending on your longevity. But that's kind of where we come back to, hey, 8%, you can clearly see that's not going to work. But one of the reasons why this really didn't work in this scenario, this client retired in April of 2006. Well, 2008 and 9, I don't think I need to remind anybody, we had a financial crisis where markets were down over 50%. And that's the problem. Again, going back to sequence of withdrawals, you're withdrawing 8% in a down market. And if you didn't catch last episode 48, the last episode that we did, go back and watch it, because there's maybe some things to think about, ways to adjust your retirement plan if you find yourself in that scenario and you are maybe withdrawing a little bit more than normal. But the market declines. Maybe in this case, their portfolio only declined 20, 25%, best case scenario. Mm-hmm. And when the market was down over 50, but they were also taking out 8%. So all that money that they took out while the market's down, I mean, that's gone. You're never making that back. And it really, it had some consequences later in the portfolio's life, and then we had COVID, we've had 2018, there was a down market. There was just periods of time where markets were down, they were still withdrawing 8%. And clearly that's not something that's sustainable long-term.
Yeah. Yeah, no, definitely. And oftentimes I think we find with some clients, or even with just conversations we've had in the past, it's easy when it comes to income planning and retirement, it's easy to kind of fixate on just a dollar amount. Like, well, I need, $4,000 a month, or I need, $8,000 a month. And, what really helps is to reframe that and say, okay, step outside of just the dollar amount or the monthly amount, thinking for a moment, and let's take a look at really what that percentage looks like. And, as you're kind of showing us here, what does that, if we consider market conditions, in different ways, or good and bad, what that really looks like. Because you might think that, hey, I should be able to get $5,000 or $8,000. And reality is that pulls a little too much weight on the portfolio itself to be able to weather those conditions.
Yeah, well, and in that example on the 8% withdrawal, if you think, okay, we're withdrawing $80,000 a year, that's $80,000 in addition to Social Security, pensions, things like that. That's where a full retirement plan, we analyze where all your income is coming from, how much of it is stable. Of course, the more stable income, that can relieve you taking some out of the portfolio, especially when markets are down. But there's a lot that goes into it. But let's look at the tile all the way on the left, Brian.
Yeah.
That is the traditional 4-5% and 5% rule. Again, the purple 4%, you retire in 2006, you withdraw $80,000 a year. I don't believe this is indexed for inflation, the withdrawal rate, but nonetheless, after that time period of 20 years, even after everything that you'd taken, withdrawing only 4%, your portfolio ends up at $1.665 million. If you withdraw 5% annually, your portfolio basically ends where you started, 1.072. Honestly, I'm more of a fan of getting closer to that 5% rule. I've seen quite a bit of research that does suggest that 5% is sustainable. And again, you got to remember, this is a 50-50 portfolio. I know our firm has a little bit different view on a retirement portfolio relying a little bit more on equities, just because, again, people are living longer.
Yeah.
We need those equity returns to outpace inflation.
Yep.
So I know we might have a little bit more equity in a retiree's portfolio than certainly a 50-50, but for illustration purposes sake, if you're in that 4 to 5% rule, even with 2008, even with 2016 and 2018 and 2020, 2022. I mean, yep. we can kind of go back. This is actually saying something too, because for those of you who were investing in 2022, which is probably most of you, 2022 was the worst year on record for bonds. So if you had a 50-50 portfolio in 2022, not only were your stocks down, 20% or whatever it was, but your bonds were also down. If you had anything, other than ultra short duration bonds. Mm-hmm. So that was kind of a double hit. But, really this just shows the tile on the left, the resiliency of 4 to 5% withdrawal rate. That is something more where I would say most of us are going to be a lot more comfortable being in that range to tell a client. And if you're somebody watching at home and you're doing this on your own, that's kind of what you want to aim for, because that should give you enough comfort to say, I'm going to be able to weather whatever storms come up. Again, one of the keys is you need to remain invested. Yeah. We've talked plenty about that on this show, but 4 to 5%, I think, makes a lot of sense. Now, does 6%? That's what the middle tile is showing. That, I think, is pushing it. And the graph shows, after 20 years, you've spent about half your money, from the original principal value, let's call it, of that $1 million. And you got to remember, over that time, we've had some pretty good years in the market of, I would say, higher than average annualized returns in equities. So maybe 6% is going to push it long term, but it's a good frame of reference, 4 versus 5 versus 6 versus 8 of what actually is sustainable. And if you're somebody that's in retirement that is currently taking withdrawals, and you analyze your situation and you say, hey, wow, I'm actually closer to taking 6, 7, 8% withdrawal. I mean, you need to have a good hard look at that and really think about, is that sustainable? Because history and math says that that's going to be extremely hard to sustain itself over the long run.
Yeah, and there are some people that we've talked to where, they're, even though it's not a comfortable thing, it's like they want to almost time it where it's like they've got maybe a chronic or a terminal condition, and they're thinking in their life, I don't need a whole lot of this to go beyond me, and so they're being a little more aggressive with the withdrawals. But that's from an advisory perspective or a fiduciary perspective. It's like you want to take the err on the side of responsibility as much as possible.
I think every advisor has heard a client say, oh, I want my last check to bounce.
Yeah.
Yeah. I mean, if you know when you're going to die, I guess you could probably get close. But that's the thing. Medicine is advancing so much and has advanced. People are just living longer, certainly, than their parents. Each generation is living longer. I mean, I'm sure, Brian, in our careers, we'll start planning for 100-year-old, end of life, and maybe even beyond.
Yeah, the Social Security max age is going to move up to 80 by the time we're old.
But we can chart off here, Brian.
Sure.
But honestly, that's the hard part, is people living longer. You need more money to get you through it. That people always say, when we're doing planning, it's like, well, if you pass away in a couple of years, honestly, there's not much to plan for. As sad as it sounds, it's harder to plan for 40 years of retirement than it is for 5. Mm-hmm. And we always go into it best case that you live a full life, but that is harder to have that portfolio sustain itself. But you need to be conscious over time of what you're withdrawing, and things always come up, but this needs to be the target that we kind of go into the plan analyzing, saying, hey, if we can be in this range, 4 to 5% personally, I'm comfortable with.
Yeah.
We can make it through.
Yeah. And it's almost like the idea of thinking of having a contingency plan. Someone might ask, well, why do I have to be that conservative? Can't I just push the 6 to 8%? I can't foresee any reasons that I would need to have that much money 20 or 30 years from now. What are some of the maybe warnings or contingencies that we can share and say, hey, have you thought of this or have you thought of that?
Well, I mean, that is a good point. Some people do, say that, but there's always unknowns. We're always planning for the things that we know, and we're trying to leave enough of a balance there for the things that do come up. I mean, how many times has a client said, oh, hey, I need to go put a new roof on my house, or something catastrophic happens where they have to then be pulling money out of their portfolio that we never planned.
Yeah.
We don't want to be riding that ragged edge.
Yeah.
Certainly. We're trying to be conservative in our estimates, and we're trying to leave enough wiggle room for down the road that having something come up like needing a new roof, or maybe, having unintended, unforeseen medical bills or something, not derail an entire retirement plan.
Yeah, absolutely. It's important to have those, think of all those potentials, and you may not necessarily have to technically throw each one into a financial plan, but at the same time, you do have to be aware of them that, hey, this
Yeah.
could happen, and having that large sum of money in the background as there in case there's not an insurance to cover it, that's important to have.
Yeah, no, 100%. And it's just good to, I think it always helps to see at least some back testing on what it looks like if you do A, B, or C.
Yes.
Because that sometimes those visuals can be powerful for people to actually wrap their minds around.
Absolutely. Yeah, thank you, Dustin. I appreciate you sharing that with us.
Anytime.
Yeah, so this is episode 49, T-minus retirement. We really appreciate you guys watching. If you have a financial professional you're working with and you haven't yet thought about this or talked about this, it's something to bring up. Talk with them. If you're seeking a financial professional to work with, you can reach us on our website in the show notes, and we'd be happy to chat with you. But please, if you enjoyed the video, I know it was brief but helpful. So if you appreciated it, give us a like, a thumbs up on that. You can always subscribe to the channel to stay up to date as we're releasing content weekly, sometimes daily. And with that, wish you all the best, and we'll see you on the next episode.
Episode 50.
That's
coming
right.
at you.